Hey guys, welcome back to your mortgage information station. Today is Thursday the 30th. Sorry I didn't get a video out for you guys yesterday. It was actually a really bad big day in the bond market, but I was at the Mariners game all day, so sorry about that. Yesterday, as a recap, the 7-year auction went off and did not do well at all. Remember we talked about on Tuesday, we had the 7-year auction yesterday, and that was going to be telling and directional support for bonds and for mortgage-backed securities. So Tuesday we talked about how we had sold off the Fannie Mae 4% mortgage-backed security had broken support at the $101 level. Well, yesterday it broke support down to $114, and today it got even worse, and it actually, for a time and a couple of times, it broke support down below $100, which is par. So a $100 mortgage-backed security would be priced at par. The reason for that is a few. The Chicago PMI numbers, the purchase money index numbers, came in much better than expected. Jobless claims were average. Greek austerity measures were. So yesterday, the Greeks voted again for the right to vote on an austerity plan. That passed, and now the Greek austerity plan that is in place has been ratified, to the chagrin of the Greek populace. Again, I don't understand. But if you remember on Tuesday, we talked about bad news for Greece is already baked into our mortgage-backed security and interest rate market, and good news for Greece is going to have more of a possibility to drive rates upward than bad news will to have to drive rates downwards. So we had some positive economic data, which hurt interest rates. We had some good news out of Greece, which hurt interest rates, and then the 10-year Treasury broke technical support at 3.1 and got almost all the way to 3.2 right now. So the yield on the 10-year Treasury broke support at 3.1. Remember, last week we were down in the 2.86 range, 2.87 range. So this has been quite a run-up. It broke support at 3.1. It's right in the middle now, 3.1 and 3.2. A lot of volume got into the market after that 3.1 support break, which is why we call them technical movements, floors and ceilings. It's because trading desks, hedge funds, day traders and the such, they're set up to make moves at different points in the market, and that's why you have floor and ceiling resistance at technical levels. So once that breaks, the 10-year Treasury yield broke support at 3.1. It was really, it was bloodshed. But we did, so we got a little bit worse rates today than we had yesterday. And then we got an intraday reprice for the worst from a lot of lenders, and then the market recovered, stabilized, and we actually got some intraday reprices for the better. So yeah, all in all, this is when we've been talking about advocating a defensive posture. If you're closing within the next 30 days, you should probably have been locked. There's no reason to not be locking, even though it still seems like we're in a bullish interest rate trend mid to long term. Short term, these adjustments are too volatile and too big, and that what you have today could be gone tomorrow, as we've seen this week. So there's short-term setbacks in every long-term rally, and we've been advocating. If you are closing soon, you should be locked on your loan. Other than that, today, the 30th of June, is the end, for all intents and purposes, of quantitative easing 2, and also it is the anniversary of the merger of East and West Germany. Where were you when that happened? Do you remember? I have no idea where I was, but I was probably in elementary school, maybe in middle school at that time. So that was, hopefully that doesn't age myself or age you if you're older than me too bad. But yeah, I will see you guys back here tomorrow. It will be Friday, July 1st, the start of a new month, the start of a new beginnings, and 5 days till I go with the family to Disneyland. So yeah, it's gonna be fun. All right, I will see you guys tomorrow, and just remember, you stay classy.